clear that the commodity super cycle, which everybody called it, lasted for only 18 months. It was supposed to be a multi-year super cycle, but guess what? It is getting punctured in 18 months. Do you think if commodity cycle is reversing, it will have serious implications for us?
Well, look, I think it's a little too early for us to know which way commodities are going. I've always said, we in Marcellus have no privileged knowledge about what's going to happen to commodity prices. But yes, if we are heading into a recession slash slowdown for the Western world, which the Western central banks seem determined to create, if there is a Western recession, it logically stands to reason that commodity prices will continue cooling like they've done for the last 3 months, and that is bound to be good news for our country, given that net we do import more commodities than we produce internally. So in late April it started, as the Fed continues hiking and as the Fed sort of shows greater determination in pushing America into at least a slowdown, if not a recession. The odds are that commodities will cool off, and by and large, that's a good thing for India.
I'll start with the sector, Saurabh, which in a sense has been a laggard. For a sector, IT, which was the best outperforming sector for 2021, has now become a laggard. Are markets getting nervous about business, or this is pure PE or mean reversion which is happening in IT stocks after a wonderful out-of-park performance in 2021?
So I'm not so sure about the mean reversion piece because, Nikunj, if it is PE multiples jagging around, I don't think there's any point in us losing too much sleep about that. But yes, there's been plenty of talk that order books of Indian IT services companies and the global IT services companies will be squeezed, will shrink in light of a US recession. But it's just been talk. We haven't seen any evidence either from Accenture or from TCS, or indeed even from, say, a company like TSMC, Taiwan Semiconductor. We haven't seen any tangible evidence of a material slowdown in tech spending by the Fortune 500 companies. So far, it's just been speculation that there'll be a slowdown in IT spend. Not a single IT company that I've spoken to or that has announced results has actually shown any weakness in their order book.
Yes, you've not seen that weakness in the order book. Last night, of course, there was unfortunate news from Apple that may slow down hiring, which impacted Wall Street overnight. But back home, Saurabh, good morning. As far as the banking franchise goes, and once you look at dominant players, HDFC is, of course, in your list, and we saw what happened with HDFC Bank, the results. It was the only stock yesterday in the red from the Bank Nifty. I know you take much longer term calls, that you want to play test cricket like a 2020 player, but having said that, for the banking pack, finally the momentum that is coming back to it. How are you approaching it? Because this is one sector which was oversold by the FIIs as well. Are you adding names to your franchise?
So we remain invested in HDFC Bank. I thought there were solid results. Similarly, Kotak Bank, we remain a large investor in Bajaj Finance, Chola Mandalam, Avas Home Finance. As we've discussed on your show before, that going into a solid economic recovery with the cost of money being low in India by historical standards, what we currently have is very low cost of money. I think we will see a very good 2 to 3 years for all the lenders that we are invested in. Are we putting more money to work? Yes, we're considering reducing some of our exposure to, say, the brokerage sector, and loading up further on the lending sector. But that's been an ongoing process to increase exposure to lenders over the last year or so. We'll potentially carry on doing so, increasing our exposure to high quality lenders, because, as you rightly said, you've got a combination of good credit growth, low NPAs, as evidenced, say, by HDFC Bank's results. In fact, provisions being released by HDFC Bank. So you got good credit conditions, low stress in the system. Almost all high quality lenders have excess capital, and over a 2, 3, 4 year economic upturn, they will shed that excess capital, grow into their capital base, and we're hoping to make a lot of money in this sector.
Right. Saurabh, what happens to telecom now with the entry of Adani into the foray, the 5G spectrum auction coming up next? I don't know if you're exposed to this sector already, but just wanted to understand how you think the dynamics within this space are going to play out and whether or not there is an investment opportunity here.
I think what happens to telecom now is what's happened to telecom for the last 20 years, which is it doesn't make any money. So because barriers to entry remain relatively low, right? It's as we've seen repeatedly over the last 20 years, not just in India, actually across the world. Every time this whole business comes along of one or two players doing reasonably well, a few more people come in, they lower the return ratios for the industry. And this is yet another industry very similar to aviation, actually, where you can have very good growth in business volumes over long periods of time, as we've had in India in telecom and in aviation. You can have very good growth in business volumes, but you don't actually make any money. You don't make money in the sense of your return on capital never exceeds your cost of capital. So I think that's the way telecom sector globally will continue to be for the telcos themselves. And as you rightly said, we've never had any exposure to the sector.
Saurabh, how will the first half of this year or the second half of this year be different from the first half? Because a lot has changed in terms of orientation, outlook on inflation, a war, a spike in commodity, central bank's narrative in terms of fighting inflation as the public enemy number one. All these will start having implications on earnings, demand, outlook. So the second half radically could be very different.
If you think about it, right, through the bulk of the post-COVID recovery, the main ally for the Indian stock market was cheap money printed by the Western central banks, right? And I think that aspect is now sort of behind us now, as is evident. The Western central banks are intent upon jacking up the cost of money at least I would say another 150, 200 bips to get a grip on inflation in their countries. So that factor is behind. I reckon the main ally for India over the next 2, 3, 4 years will be the gradual realization by foreign investors that Xi Jinping is simply not going to make China the China that they thought they were investing in. So this whole notion that the West has cultivated over the last 20 years that China is some great country to invest in, I think that notion has gradually crumbled. There is still a body of hope in the West that the good old China that they loved and invested I think 6 times more money than they invested in India. They still entertain that hope that China will come back. I reckon that through the winter, that hope will crumble. And therefore, if we look ahead, the main ally for India will be the reallocation of the $3 trillion odd that Western investors have pumped into China over the last 20 years.
What is the best way to look at autos? A play on low commodity prices? A comeback on value?
What happened here?
The smile tells me that either you completely agree with me or you completely disagree with me.
No, so I think
giggle, it's not even a smile. I'm wondering what's making you
It was
giggle.
a very open-ended question. What is your view on autos? Because it's a very open-ended.
Nicely put, Mukherjea, a lovely question. I think it's a very difficult sector. We've struggled with auto historically because, as you said, right, we've tried to invest in auto thinking that it's a play on consumption, only to realize that the auto manufacturers and the auto hanks, both the OEMs and the hanks, don't actually have that much purchase and don't have that much pricing power. They seldom make a good cross-cycle return on capital. So therefore, the only way you can make a little bit of money in auto is timing the cycle perfectly. If you get auto broadly has 6 good in a 10-year period, auto will have 5, 6 good years, 4, 5 bad years. And if you can get those 5, 6 good years, you make a decent return. You make around 20% return per annum if you can get those good years. But timing that has proved to be difficult. And it's one of the few sectors we have tried to do it and it hasn't quite worked out for us. So if you were to take a positive view of auto, if you invest in great franchises, and in all honesty, we have investments in Eicher Motors, we have investment in Suprajit Engineering. We think both are high quality franchises. Both have demonstrated an ability to deliver return on capital above cost of capital over long periods of time, smart capital allocators, good competitive advantage. So if we take the bullish view, as we go into an auto recovery, an economic recovery, abundant availability of credit, this sector should compound for us at around 20% on these stocks. Suprajit and Eicher Motors should compound for us at 20% over the next at least 2 to 3 years until the next auto downturn comes along. But the challenge in this sector, as you're rightly alluding to, is you not only are dependent on underlying demand holding up, you're also dependent on commodity prices being supportive, and as we've learned over the last 6 months, you're dependent on supplies of things.
Or what did you accumulate?
So I think we took a leaf out of what we had done in March 2020, where we loaded up on some of the stuff that had corrected. So remember, late March 2020, we loaded up heavily on Bajaj Finance, almost doubled our position in Bajaj Finance. Late April 2020, we almost doubled our position in Bajaj Finance, and that worked out neatly for us. So this time around, we've loaded up heavily on Dr. Lal Path Labs. So it's had a very similar correction to what Bajaj had in that run up to the in the initial COVID panic. Bajaj almost halved. Similarly, Dr. Lal halved over the last 6-7 months. So we've I think about 300, perhaps 400 crores now of Dr. Lal Path Labs over the last couple of months.
Saurabh, I'm intrigued or curious to know, what is it that you've actually sold in the past 2-3 months?
Right. So what we tend to do is when we do these rebalancing, right, where we look for great franchises that we own which have been punished, we obviously have to sell something to buy whatever it is that we are buying. So on this occasion, Dr. Lal Path Labs. So the stocks which had one of the stocks which had actually done very well for us till 5-6 months ago, when we lightened up and reallocated some money to Dr. Lal, was Titan. So we still have plenty of Titan, but it had done extremely well, and we therefore lightened up on Titan and reallocated some of that money to Dr. Lal. Back in April 2020, I remember when we loaded up on Bajaj Finance, we lightened our Nestle position and we lightened our Abbott position then. Because in the early months of COVID, Nestle and Abbott had done very well as people had panicked and then sold Bajaj Finance. We reallocated a good 8% of the portfolio away from Nestle Abbott towards Bajaj Finance. This time round, over the course of the spring and into the summer, it was Titan where we took some money out and put that money in Dr. Lal Path Labs. Just to be clear about this, I own all of these stocks through my Marcellus portfolio, so do my parents, and so do our 9,000 clients. So whatever stocks I'm talking about owning, we have a strong vested interest in this.
Saurabh, some would argue for diagnostics, the real hurrah moment was COVID. It was not RT-PCR test, it was the additional test which were compulsive test, whether it was a D-dimer test or a CRP test, the medical tests which were done. And that in a sense gave them pricing power and a lot of business. That business is over, and I hope that business is over forever. Nobody wants COVID to come back. So what happens to this sector, which got re-rated and is now getting de-rated? Where will it fit in?
So I think where you can see the reason we had invested in the sector long before COVID, and the reason we are loading up further on Dr. Lal is non-COVID sales were growing for Dr. Lal, and indeed non-COVID sales were growing for others at a decent pace, but non-COVID revenues for Dr. Lal were growing at 15-16% before COVID, and they're growing at 15-16% even now. And that piece, right, 15-16% revenue growth, and therefore earnings compounding around the 20% mark, and free cash flow compounding around the 25% mark. That piece, we reckon, has a very long growth runway, because in what is a $10 billion sector, diagnostics is a $10 billion sector in a country, barely $1.5 billion is formalized, right? The national chain, the Metropolis, Dr. Lal, etc. Barely $1.5 billion is formalized. So you've got 85% of the sector in the mom and pop side, and therefore there's a natural consolidation play that will happen here, which we reckon the strongest free cash flow generator, which is Dr. Lal, should benefit from. Leaving that aside, one of the big benefits of COVID has been you can clearly see greater focus by people on their health. So ancillary benefit has been, and health insurance take-up has risen dramatically post-COVID. And as people come out of COVID with a greater focus on health, we're hoping that the whole health and wellness aspect of diagnostics also comes forth, executive health checkups and so on. So there's a structural driver, which is formalization of the sector away from mom and pop towards national chains like Dr. Lal. And secondly, there's a lifestyle aspect, which I agree at this stage is a little bit of a conjecture on our part, but it does look like there seems to have been a shift in people's spending habits, and they are placing more emphasis on their health, and therefore the wellness aspect of diagnostics should come to the fore. So plenty there to play for. We're not looking for any COVID benefit to be associated with this name. Mid-teens earnings growth, 20%, sorry, mid-teens revenue growth, 20% earnings growth, 25% free cash flow compounding. We can make a lot of money here.
Okay, that's the word coming in from Saurabh Mukherjea. As far as diagnostics goes, this Marcellus has loaded up on Dr. Lal Path Labs. Earlier in the year, it doubled up literally when it came to its accumulation of Bajaj Finance. Saurabh Mukherjea, thank you so much for being live with us today and taking us through what Marcellus' strategy is these days. Well, how should you be preparing for the next bull run? What should you have in your portfolio? How are market veterans approaching D Street? It's time now for a segment, Word from the Wise. Every morning, Samit compiles a list for us, and he's joining us live now. Over to you, Samit.
Well, firstly, from Girik Capital now, they are selective on the banks because they're expecting this sector to perform well in this cycle. Along with this, they are also bullish on logistics because they're seeing demand coming back in this sector, and hence stock specific, they are bullish on Blue Dart. They're also bullish